All right, Rima, thanks a lot for taking us through that complete roundup on what is expected from the big tech companies in Q3. But to discuss more on this, we're also joined by Devang Bhatt of IDBI Capital. Devang, good morning and thank you very much for joining us. This is Pavitra. I'm sure you heard what Rima had to say in terms of what is expected from the tech sector. And, of course, growth slowdowns are penciled in across the board. But can you tell us what is the kind of slowdown that you are estimating from at least the bigger tech companies?
Yeah, good morning, Rima. So what we are expecting is that Q3 this quarter would be around, 0.7 to around, just 2.8, which is 2.8% is because of HCL Tech, which has a higher product revenue growth. So mostly IT services will be around, zero point 0.7 to 1.5 kind of a growth. So it will be far lower than what Q3 last year was because of, now what is expected is normal furloughs, which was there in COVID times. And the macro is also slowing down the discretionary spends.
Is there a risk of earnings downgrades this time, Devang? And what about valuations? If we do see some misses on the earnings front this time, do you think valuations will correct? What's the investor positioning like?
So valuation has significantly corrected. So what we had issued a report in around May, that the valuation will convert towards 5 years. So almost many companies have corrected towards their 5-year average, which is 10 to 15% kind of downside is maximum 5 to 10% kind of downside is there. So what we think is that valuation is corrected, but the issue is that earnings, considering that all the clients that they have, so those clients will have certain specific challenges, and on that basis earnings can turn around, and on that basis valuation can slip, considering the growth that they give in the coming quarters. So what we believe is better to stick to large cap like Infosys and TCS, which they are able to maneuver the slowdown or discretionary through cost takeout kind of opportunities.
So you said the maximum downside is about 5 to 10%, right? That's going to be earnings downgrades or valuations? Didn't quite get that.
So in terms of valuations, I'm talking about. In terms of earnings downgrade, there might not be that much earnings downgrade, because that has been already been factored in the previous 2 quarters. So more from a valuation perspective, so that they will be near their 5-year average.
Devang, the other big question is on margin, right? I mean, we have spoken to most of the tech companies, even in the past quarter, they are talking about attrition, sort of that situation improving a little bit. Do you think that this is likely to aid margins and we will see an improvement in this quarter as well?
Yeah, so margins expectation is gradual that it will improve. This quarter, there will be some margin improvement. Going forward, there will be far higher margin improvement because, the supply side issues that were going on, that has receded. Plus, freshers have been inducted. And to a certain extent, the cost pressures that they were facing earlier, that has all receded. So we believe, margins are going to expand from here on.
How much of an expansion are you factoring in here for the margin?
So this quarter, we are expecting around 35 to 117 BPS margin expansion. Going forward, probably 100 to 150 BPS margin expansion is possible for FY24.
Would you buy into any earnings related correction this time in the IT stocks?
So what we believe is, in terms of Europe, geography wise, Europe will be weaker. So we prefer that, those companies which have higher US exposure, and those who have higher BFSI or healthcare kind of an exposure should do well. So if there is correction in such stocks, we would be a buyer in that.
Okay, and what is your reading on the mid-cap IT space as well? How much do you think we could see in terms of a downside on the stock performance?
So in terms of mid-cap IT, the issue is that, there are client concentration, and certain clients might not perform because of, pressures in, say, mortgage, or pressure in discretionary retail or pressure in communication side. So we prefer those companies which have which are able to maneuver this, like those who have a vendor consolidation opportunity and they can maneuver that. Those who have good Fortune 500 exposure, and in terms of valuations, certain stocks have corrected well. So that's why we believe LTI Mindtree to a certain extent should do well. Signed, and we have recently initiated a coverage on Newgen, which has lesser exposure to the developed world and more exposure to the emerging markets, and they can do well in terms of revenue growth. So at least 20% kind of growth this year they can do. So this should do well for them, and they have BFSI exposure, and their India and EMEA is doing well. So we are bullish on Newgen.
Okay, thank you very much, Devang, for joining in. Look forward to chatting with you as the numbers trickle in. Get into a break. On the other side, we'll discuss what's buzzing in the commodity space. Manisha Gupta joins in next.